big recovery for the Russell. You guys can't see it yet, probably, but I see it. Wow. So the main thing is as long as the S&P keeps going over, now people can see. Great, thank you, everybody. So yeah, look, as long as the S&P is over 4,500, it's consolidating for the next move up, which is sick, since 4,500 is a 50% line. But what are you going to do? Just keep paying. What you're going to do is keep paying more money for stocks. So look, I'm really comfortable going after these low price things. Like well, let's start with today. Like today, we looked at Rio Tinto. I'm going to keep looking back and see like who hasn't been performing. Apple is still not that expensive. It's expensive for Apple because it's usually ridiculously underpriced. But the thing about Apple is okay, this is such crazy money. They're hovering at $2.5 trillion. They added $500 billion this year in market cap. No worries, it's just a normal, typical year. They added $500 billion of market cap. So they added. I would say there may be 10 S&P 500 companies at 500 billion or higher. So they added like one of the biggest S&P 500 companies in value this year. And did they deserve it? Yeah, because they went from 55 billion in earnings in 2019. Didn't lose a step in 2020, except the step they lost was the rapid gain that they often have. And now this year they're zooming along to $94 billion in earnings. So call it 100 billion, which it isn't yet, but it'll be 100 billion at some point. So if they're earning 100 billion and they cost 2.5 trillion, they're playing 25 times earnings. But when you have that kind of growth, because they were at 50, 45, blah, 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 they jump up to 90s. They're going to, at some point, it might be 5 years from now, but they're going to jump up to 130, 140 billion. And all of a sudden, they're going to be really cheap again at this price. So nothing wrong with Apple. And so this morning we were talking, going back to where I was before I digressed. Was it here? Yeah. So we talked about Apple, and basically on Apple, I said, look, it's expensive. We'd like to play it, but it's kind of high. We'd love it if it came down. But you know what you can do is you can sell the, and we don't have Apple in the LTP. So you can sell 10 Apple puts, excuse me, the September 2023 105 puts for $7 to be precise. So it's basically 2 years from now. The 105 puts, 105 would be way down here on the chart. And we're selling this for $7, so the net cost is $98. So do I want to buy Apple for $98 a share? Yes, I do. It's at $153 a share. I'd love to buy it for $98 a share. Can I do that? No, but some idiot is going to pay me $7,000 to promise to buy it. I don't, it's hard for me to emphasize enough the value of doing this, of selling these puts and promising to buy stocks when they're cheap. You're going to buy stocks. You're here because you want to buy stocks, right? That's your thing. You like buying stocks. So you want to have investments. You want to be in the market. So if that's your plan, then why not get paid for doing it? Somebody's willing to pay you to buy stocks. And all you have to do is, instead of saying, can I buy Apple now? Can I buy it on the dip? Should I buy it here? Should I buy it here? What if it goes here? What do I do here? Instead of doing all that bullshit, why don't you just take a stand and say, yes, if Apple gets to $98 net, I will be very happy to buy myself 1,000 shares. It's not going to happen, but instead of that happening, you can get $7,000 in cash right now just for making that promise. Why would you not do it? And I'm not saying it has to be Apple, but I'm saying anytime you have stocks, anytime your portfolio is low on stocks, which we are now, we are very low on stocks. We just cut half the long-term portfolio. So we have basically $2 million to spend. And so would I like to spend 100,000 of that 2 million on Apple? Sure, I would. Do I want to spend it at 150? Not so much. No, it's not a terrible price. We could play with it. We could tweak it. We could do a bull call spread and a put, whatever. But you know what? I'd rather wait for it to come down a little bit. But while I'm waiting, in case it never does come down, I'm going to sell some puts. So I'm taking assuming we have $2 million in buying power in the portfolio, I'm allocating 5%, $100,000 to owning 1,000 shares of Apple at $98. And I'm getting paid $7,000 for that allocation. So if you think about it, I got this money sitting around, it's not doing anything. I can do that 20 times. I can take 20 positions and do that. And if I take $7,000 20 times, it's $140,000 in my $2 million portfolio. So it's 7% per year for 2 years. So 7% per year just for the stocks that I decide that I'm going to promise to buy. So what have you done? You clearly boosted your performance by 7%. You're doing 7% better than you would have done. You did nothing. You took in the cash. You're taking $140,000 in cash. You promised to buy 20 positions, and there's your money. That's one of the reasons we consistently outperform the market, is because we do things like that, because we're always selling those puts in the long-term portfolio, which is, oh, there it is. We did not, they got a big weekend planned, a lot of work. We did not yet do the adjustments to the long-term portfolio, so all the old stuff is still there, but you guys get the idea. We sell puts. We have 22 short puts in the long-term portfolio. They're not all $100,000 worth of stock to buy, but let's go 10 times 50, 50,000, 40,000, 100,000 there, right? 200 times 500, yeah. Yeah, 20,000 there, 30,000 there, 20,000 there, 30,000 there, 60,000 there, 25,000 there. So it's that concept. These are the blocks that we're promising to buy. Now, keep in mind that you have a portfolio margin account. If you have $1 million portfolio, you have a portfolio margin account. But even if it's an IRA, you're not risking. Boeing's a bad example, but even Boeing, you're not risking $100,000 to sell 5 Boeing puts, because it's extremely unlikely it's going to go to zero. Okay, Boeing just had their fleet grounded and whatever recently, and even with all that going on, how low did they go? Then they did lose about half, but we're still down there. Why all these? La-di-da. Okay, so Boeing just had a catastrophe. That's not, yeah. So Boeing had a catastrophe, and we had the virus, and everything else went wrong. They had a very crappy time. But even with all that, they went from 350 to 150, so they lost about half their value. Then they're coming back. They're still fairly cheap, and we can talk about that also as a bargain stock. So we don't think it's likely that Boeing's going to 50. We don't think it's likely it's going much below 100. It's going to recover. So basically, we don't have that risk. So when you look at this in your portfolio, there's one thing you have to get used to, is what's the realistic risk, not what's the total possible risk. Now, if you have an IRA account, they're going to allocate all this money into out of your margin for buying. So it does affect your buying power. Generally, put selling isn't the best thing to do in an IRA. But if you have a margin account, portfolio margin account especially, these are very low impact to your portfolio, because we're selling out of the money puts HMY is at 375. You're selling the $3 put. That's about 20-something% out of the money. Once you pass 20% out of the money, it's a very, very small margin requirement to sell these things. So you become more concerned about what's my risk? Well, what is my risk? What is my risk in Macy's, which is at 22, selling an $8 put? I don't have any risk. We actually killed this one because it just paid because it was 98% in the money. But what's my risk when I sell something that far out of the money? Oh, here's Pets. Okay, so for Pets is $28. We sell the $30 put, but we sold it for $7.35. That's $23. 20% down below where it is, and that's generally going to be our sweet spot, is 20% off. Who's this? TD. Yeah, TD Bank, right? Yeah. So that's TD Bank. TD Bank, $65. We sell the $55 put. We sold it for $3.50. We're at like $52, $51.50. $14 below. It's more than 20% below. Now, this one happens to be even. This is still a great little put to sell. And it's only January 2023. So what's the risk that TD Bank drops more than 20%? And what's the risk that TD Bank drops 50%? TD Bank is the Bank of Canada. I mean, they are half the people in Canada have their money in TD Bank. They are not going bust. No one's going to let them go under. Canada prints its own money. You have to think of that too. How did banks fail in 2008 in Europe? They failed because the European Union wouldn't bail out the local banks. No matter how important a bank is to their system, they didn't bail it out. Here, we had our banks fail because Congress didn't bail it out. The first time they went for the TARP, they didn't do it. Everybody started collapsing. Then they said, "Oh, that was a bad idea," and they went back and started doing the TARP thing. Banks fail when a government refuses to bail them out. When the government says, "Oh, it doesn't matter if a bank fails," turns out it does matter if a bank fails, and I don't think anybody has that attitude anymore. And certainly Canada cannot afford for TD Bank to go under. So you have to think about what's your actual risk on these things, not what your potential fantasy risk is. These guys, TD Bank's not going bankrupt. R.R. Donnelley probably not. Pets is not. Again, Pets could. You never know. OIH is an ETF, so it can't go bankrupt. Mitsubishi Financial also very unlikely to go bankrupt. Macy's. So unless something's going to go bankrupt, you're not going to lose all of it, and therefore your risk isn't all of it. You can't look at it like that. You can't look at it like, oh my God, I'm risking this much. You're not. You're promising to buy something of value. If I live in a house and my house is $500,000 and there's a house named my neighbor is selling his house or thinking of selling his house, and he says to me, "Hey, if you promise to buy my house for $500,000, I'll pay you $100,000 for your promise to buy it." So do I look at that house and say, well, that house could be zero when I buy it and it'll be a big waste of money and taking such a risk? No, I say, Jesus, for $400,000, I would totally buy that house. Or what if he sells you a $400,000 contract for $50,000, whatever, then you're down to $350,000. Then you say to yourself, well, geez, $350,000, that's ridiculous. And that house is completely worth $350,000 because I know that if I tried to rent my house now, I would get $2,000 or $3,000 a month for it at least. So I could cover the mortgage, which would be $2,000 a month, I imagine, on a $350,000 house. So I could cover the mortgage with whatever I rent it out for, and it's a great investment long term. Because I know there's a value to the house. And if I sit there and I try to talk you out of it, and I say, oh no, $350,000, you're obligating yourself for $350,000 to buy that house. And that means, what if it goes to zero? You're like, it's not going to go to zero. I'm like, well, what if it goes to 100,000? It's not going to go to 100,000. The freaking 4-bedroom house in a nice neighborhood, blah, blah, blah. It's not going to 100,000. Even if the economy completely collapses, it's not likely to go to 100,000. And even so, you're going to be able to rent it out. You know you can cover this thing. You know there's value. It's stupid to have an argument to say there's no value because you know for a fact what the house is worth. The problem with stocks with most investors is they don't really know what it's worth, and they can be talked out of a real value position. That's the problem. You have to know what something is worth. You can't just treat everything like it's just a number on a piece of paper. There's a company behind this thing that does stuff, and they have value. And that's why when we pick our plays, and we are definitely value investors, we look at what they're really worth, these companies. And when we pick a target, it's a target where we say we really would commit heavily to buying the stock at this level. Obviously, unless something changes, but it goes back to many things. Like when Boeing was high, and I always, it's a terrible thing to say, but when Boeing was high, I always tell people, I'm like, wait for something bad to happen. Something bad always happens with Boeing. There's a plane crash, there's a hijacking, there's a 9/11. It's always something. Here's Boeing for many, many years. So they are super up in the 60s, then they crash in the 70s, then they're recovering in the 80s, and they crash again for whatever. I don't know what the reasons were. Then they go way up in the 80s, and they go flying back down, and they go super up and super down again. And we know what this one was. This was, well, in the 90s, actually. This wasn't even the market crash. Oh, I'm sorry. It goes even further. It just never stops. This is how they go. Then you've got the 1999 crash. Then you got the 2008 crash. That's with the market, though, not particularly Boeing did something. But, the company goes well, little fault, company goes well, something goes wrong, company goes well, something goes massively wrong, engines falling off planes and stuff. Then it gets better. Because, look, they were developing these new planes, and they had orders up the ass for all the new planes, and then it turns out the new planes blow up in the sky. No, it wasn't that. It was the software was nosing the plane down, right? There was the fault in it was a design flaw, really. It was really a design flaw. They did a workaround now. But the bottom line is they spent all their freaking money for this decade to make these planes and got these orders, and then all of a sudden the planes don't work. When they start putting them in the air, they start falling out of the sky. That's bad. That is a fundamental problem, and we analyzed the crap out of that. But we decided down here we got gung-ho bullish on Boeing, and we already got out of those plays. We played it out, but now they stabilized a bit. Now we look at the actual operation of Boeing. So we say, hey, how is Boeing doing? They still have 7+ years of back orders for their planes. Their market cap is $128 billion. Their sales are only 58 billion last year, 75 billion this year. They got really, really dinged, but they were already dinged because they were grounded here. So sales went way down, but they've got the back orders to go back to this level as soon as things really smooth out. They're going to be back in business. Even if the airlines start canceling, Boeing is still going to be delivering, and they're going to come back to a $10 billion bracket of earnings. Because this stuff back here, they were still doing the R&D to make the new planes. Now they've got the new plane designs. All they got to do is crank them out of the factory. The problem is they took a huge hit in 2020. It took an $11-12 billion hit. Didn't get bailed out. So that money is going to come off their earnings. So you figure this will be more like 9 or 8 billion for the next 5 years instead of that, because you got to pay off the even if it's not debt, you got to replenish your cash, so on and so forth. The problem with Boeing now, though, is the position they're in. They can't take another hit like that, and that's what you got to worry about. It's like, will they end up taking another gigantic hit? But 128, if you say they've got a capacity to make $10 billion, that's super cheap for Boeing. It is super, super cheap, but maybe still I'd like to get it for less. So then you got to go and look and say, well, what could I do? I mean, look at 2023, and we say, well, okay, I won't pay $219 for Boeing, but I'll pay $150. $150 seems super reasonable, and I see that the $150 puts can be sold for $9. So now I'm interested, right? Because that puts me at net 140, and 140 is what, 33% down from where we are now. It's also pretty much where it bottomed out here. Well, not really, but I mean, it kind of held this zone more. This is a 140 zone over here. I had it Here, okay, so that's about 140. So it more or less held that area, even as it dipped. It had, obviously, you would have been very upset about that spike down, but there you go. You got to take that into account too, though. If I sell the 150 puts and it goes down to 100, I'm going to be down $50 per contract at least, and I'm going to have how many contracts? So that's what you have to look at as your risk. My risk is being down $50 a contract on Boeing if I happen to have bad timing and they get caught up in some bullshit and the thing goes back down to 100. Can I withstand that? And to that extent, that's what your risk is. So maybe I don't want to have too many contracts, but if I have 10 and I risk owning Boeing at $100,000 and I might be down $50,000, I'm sorry, 150. I risk owning $150,000 worth of Boeing, and I may be down as much as $50,000 on those contracts at any given time. Can I withstand that? And the answer is, of course, yes. It's still, if you've got $1 million portfolio, it's a very manageable amount that you can deal with. But you also have to consider, what else am I taking that kind of risk with? So Boeing's a bit volatile. It's not as low as we wish it was. So I'm not running after this one. That's why Boeing wasn't mentioned in the post. But I'm not running after Boeing, but it's just another one that came to the top of my head where I was saying, oh, we can probably get some good prices. It's tempting for sure, but I would be so much happy if we could catch them on a dip back to like 175 and then sell. But that's how you got to think about these stocks. You got to look at it that way. You got to say, well, how, what are their real prospects? So they pass their problems. We don't really know what COVID's going to do. Also, by the way, I got to tell you, spending 2 years pretty much at this point without any particular business travel has made most of the people I talk to, most of the business people I talk to, the ones who have companies and such, they're pretty aware of the fact that this whole concept of traveling for meetings is stupid. I don't think that's going to come back so quickly, honestly. I have conversations with people because we're working on deals in different countries, and we're working on deals in different parts of the world and around America. And every once in a while, I'm tempted to say, you know what? I said, why don't we just like get together here or there? And we always end up going, nah, you know what? What are we going to really do? I'm going to get in a plane. I'm going to go to New York. You're going to meet me in New York from Philadelphia. We're going to sit down together or something like that, and we're going to have a lunch together, and then maybe a dinner together, and then the next day maybe another lunch, and then we'll be, then we move on and we set up some more meetings on the phone, whatever. It's like, that's a lot of work. That's going to take us like 3-4 days of our time to spend 6 hours talking, and that's kind of silly. Not to mention the airfare, so you got an airfare, $500 of airfare, you got $1,000 of hotels, eating out, and so on and so forth. It's $2,000-3,000 to spend 6 hours talking to someone in person, as opposed to just picking up the phone and talking to them. It's not as much fun, and I do believe that you lose a bit in communicating when you're not talking to someone, and the video communication is bullshit. It's just different when you do spend a couple of hours talking. But also in reality, though, even unless you're doing the actual numbers of a meeting, most of the time that you're sitting there having a dinner meeting or having a lunch meeting, you're generally talking about other things, and you spend maybe, out of a 2-hour meeting, you might spend 30 minutes really, really directly talking about business. So you could wrap this whole thing up in a few phone calls and not do it. And more people are getting in the mindset where they're like, well, what the hell are we doing then? Why do we want to go back to that? And how is that going to affect the airline industry and the hotel industry going forward? The business traveler is their profit center. Justifying those first class tickets and so on and so forth. That's all business travel. That's all people with unlimited expenses and so on and so forth, going back and forth and staying in the suites. These are people who don't spend their own money doing this. It's a company's money, and I don't know if that's going to be a long-term industry anymore. I think it's going to be severely curtailed. Let's put it that way, because it's very obvious to everybody that this is not a necessary thing to be doing. and certainly for, company offices and such to go to various places when when their company's spread around different parts of the world, they don't need to go physically visit everywhere they are. I used to do when I would do efficiency studies for companies, I would look at the time people would spend traveling and going places and whatever, and I would say to these guys, I'd be like, okay, look, how much unproductive time do you actually spend? And meanwhile, like, you have a guy who's like a CEO and he's got 50 branches around the country, and in any given year he tries to get to 10 or 12 of them. So basically every month he's making a 1-week trip, that kind of thing. And you say, well, what are you really doing this week? I walk around the plant, I talk to the people, I get a feel for what's going on. Yeah, there's definitely a value to that. But gosh, I mean, how much time are you spending? How much incredibly valuable, highly paid CEO time are you spending to basically just visit a place and spend, one productive day doing it? It's just terrible use of people's time. But anyway, so people are starting to realize that, and they're realizing they can be pretty much just as productive not doing these things. So the question is, what's going to really happen? And what affects the airline industry ultimately affects Boeing. So, yes, they've ordered new planes. See, the thing about the 737 MAX is their fuel efficiency. And this is why this was where the design floor came in. They moved the wings forward on the plane to save 20% fuel, but unfortunately that caused the plane to tend to nose down. But then the software they put in to correct the plane when it noses down caused it to be much worse. No, wait, I know what it is. I'm sorry, it stalled. It would stall because the wings were too far forward to save fuel. So in other words, to save fuel, you're skirting the safety limits of stall speed. And so the planes would tend to stall. The software that detected the stall would nose the plane down to increase speed. And the problem was the sensor would trigger like multiple times in a row, and the nose would keep going down and down and down and down, and it would put the plane into a nosedive automatically. And the pilots would freak out and not know what the hell was going on because there was inadequate training for the whole thing. But anyway, so they left the wing design the way it is. They fixed the software. That's how 737 MAX are. They still have a tendency to stall. Because what you had to do is move the wings, but if you move the wings, you lose the fuel efficiency. So fuel efficiency is more important than your life. Remember that. So the bottom line is, though, that the airline companies have to have the more fuel efficient planes. They cannot fly inefficient planes. That's not a cool idea. So this is going to happen. They're going to replace their fleet. They're going to go with these planes. It's going to be many years of profits for Boeing, regardless of how much damage it does to the airline industry ultimately to buy a bunch of new planes and then find out that the passengers aren't coming back. And we had that yesterday. I think it was yesterday. No, it was 2 days ago. It was Monday. So on, here we go. So on Monday, what? You insinuating I'm not logged in? So on Monday, we had talked about this. And this is what I'm talking about on, we already did the interview. This is what I'm talking about on Canada's thing tonight, BNN on TV, because this is what really bothers me about the rally is, you've got this industry, the travel industry, the Norwegian cruise lines. This is as of last quarter. This is second quarter, 99% down from last year. Carnival, 99% down. Royal Caribbean, 98% down from last year. The cruise lines are dead. Las Vegas Sands, 64% less revenues. Hilton, 46. So Vegas, very, very bad. Wynn, minus 40%. Marriott, 40%. Marriott is half the hotels in the world now since they bought out Hyatt. Booking.com, of course, 40%. Booking.com just reflects this problem, right? And now, remember, we shorted them early on in the crisis. I was like, aren't they going to go down? It's like, that's so logical, right? If it's a travel ban, it's not going to be bad for Booking.com. So, and all the industries, as I said, the market's up 50%, and the only people who are up 50% is the semiconductor sector. The rest of the sectors aren't up anywhere near that in revenue. There's no justification for these prices. But this is a complete disaster. Yet, if you look for these stocks, this is what's crazy, because if you look at the stocks chart, and you look at RCL, actually, we need a better history, so let's do it on Yahoo. Yahoo. What do I do with it? There it is. So you look at 5 years. So here's Royal Caribbean. They were 130 before the crisis, and now they're 90, but that's, or 80, 83. And Carnival was 60, and now they're 30. Well, that's about right. That probably makes sense. BKNG. See, but this makes no sense. Booking.com was at 1800, 1850, right? 2000. They're still at 2000. They're back. This great short when we did that went down to 1200. But why are they at 2000? Where? What do I do? There. Where do you see that they should be at 2000? What possible indication do we have here that they should be at 2000? That just is no sense at all. Who else are we looking at? Las Vegas Sands. Okay, Las Vegas Sands is down a reasonable amount compared to where they should be. WYNN. And Win's been all over the place, haven't they? But let's say 150 was normal, they're at 101. So that's, probably fair. But how gung-ho are we that they're all coming back like this? What do we see? Marriott. Back to normal, back to 130s. So I mean, honestly, these are good shorts. They're down 40% right now. They just announced a quarter 40% down in revenue, and that was June. Everybody thought they were going to have a good summer. They're not having a good summer. And when are they going to completely recover? Will they ever completely recover? And now we look at Marriott and we say, well, what the hell? And again, Marriott was one of the ones we bought when they were way down, but now they're stupidly high. $44 billion. They never made $2 billion. 2018, they almost made $2 billion. 2019, without a pandemic, before the pandemic, they were already way down in revenues. This was more of an aberration, I imagine, the 1.9. I'd say this is normal, 1.4, 1.3. So they're back to 930 in 2021. They're back to $1 billion. But then next year they're super enthusiastic and they think they're going to be 1.66. I don't think that's going to happen. And they think everything's going to be back to normal. And even at 1.66, so they're skirting it, right? It's still 30 times earnings. So there's a lot of discrepancies in the market. A lot of things are being priced this way for various reasons. And I think you got to be very careful when you're comparing a stock. Don't look at how they did last year compared to this year. Look at how they did in 2019, 2018, and then say, well, that's probably where they would be if the pandemic went away, and there was no stimulus. That's the other thing. This And this includes the federal government, not necessarily bailing them out, but they were bailouts and stimulus and low rates and all kinds of loans and all kinds of things happened. So these numbers include stuff that isn't normal. What's normal is this. This is normal business in a normal year. If they're doing 20 billion in revenues, how is it they're suddenly going to do 18 billion in revenues and make more money than they made significantly more money than they made when they had 20 billion in revenues? How does this work? People are in fantasy land with a lot of this stuff. They don't understand what's going on. And you got to be really careful, okay? So with these investments, you got to look at every single thing and be skeptical about like whether they're going to make these earnings or not. Are these numbers going to come in? Let's see what else is going on. Oh yes, back to the thing. Wait, what's this? Where did that come from? Oh, here we are. Okay. All right, so there's Apple. That's one I do like. And you guys can see, like lately, I've been very focused on these PE ratios and buying stocks that like justify the earnings. I got to make 10%. I got to make 10% to keep up with inflation. That means I'm trying to get a PE around 10. That's really hard to find in this market, but that's what I'm looking for. And we got Rio Tinto. Now, we have Rio Tinto is a great inflation hedge, right? Because they're the world's largest copper miner, and if you look at them, they're Rio. So they're basically $120 billion at 75 bucks. They make an easy $9–10 billion a year. So that means I'm paying 12 times previous earnings. They are, in fact, though, moving significantly higher in revenues. Last year, what I love about Rio is they held up last year. They made $10 billion last year. Didn't bother them. 44 billion revenues, 9 billion profit. This year, they're getting significantly more revenues. They're claiming some outrageous amount of profit, but we checked it, and they did make $12 billion in the first half. So, I mean, they've expanded their business significantly. And meanwhile, nobody's paying attention to them. It's so funny. If they're making $24 billion and you can buy the company, let's say 20 billion average over 3 years. But if they're making 20 billion a year and you can buy them for $121 billion, that is what, 6 times earnings. Why would I not want to be involved in a company like this? They're growing. They're dropping more money to the bottom line. They're in great cash position in the first place. They didn't lose money last year, so they're even crisis proof. And the price of metals and copper and such are going up. So it's a good time to be a miner. It's pretty much of a home run kind of investment, right? I mean, it's exactly the kind of thing you should be investing in. So very simply. We already have a Rio play. The Rio trade we have in the long-term portfolio is the alphabet song. Here we go. Okay. So here's Rio. We did a more aggressive trade. We sold the 6722 puts. We didn't though. There's the special dividend and all the options got changed, but we sold the 6722 puts. The stock's at 75, and that's down from where we bought it. This whole trade is down from where we bought it, but I mean a little down, not much. But so we sold the 6722 puts. Those are really not in trouble. We're showing a $1,300 loss on those, but they're not in trouble yet. The stock's still at 75. But we're showing negative 1,300 on the puts. We bought the 6722 calls for $18. But then we sold the 87 calls for $9. So what did we spend? We spent net 9. Forget the puts. We spent net 9 on the 6722. So we spent 76.22. That's what we're in for. 76.22 is our break even. They're currently at 75. What are we going to do? We're going to roll these out to next year to 2024. We're going to sell some 2024 puts. Some 2024 calls also. and collect more money. So we're very much on plan for this. This is not bothering us at all. Our break even is very close to where we are now at 75. What I said it was 67 plus 9, so 76. So 76 and change is our break even. We're at 75 now, and we sold the 67.22 puts. You take those puts into account, and you subtract. Well, it's only 10, so math. It's not 4. No, yes, it was 4. It's not 5. Yeah, it is 5. $5. So you subtract $5 from the $69. So we're really breaking even at 64. No, wait. Sorry, 76. So 76 minus 5 is 71. So our actual break even on this trade is about $71. So this trade breaks even at $71. Rio's at 75, and it's potentially, well, at 87, this is not likely, this is less likely to happen now, but at 87, it would be a $30,000 trade. And currently, it's a credit trade. Oh, no, not quite a credit. It's 18, 9, 6, about a $2,000, $3,000 cost to this trade. And I would say probably if I was doing it from scratch, I'm still comfortable with 67.22, but I'd probably go down to the 82.22s or whatever the hell they have there and pick up a few more bucks and lower the cost. But great trade. Or in fact, actually, I'm sorry. So if I was doing it right now, we go back to talking about this one. If you're doing it right now, this is a good ratio. I did this ratio though, so we laid out no money. I did this ratio because I want to be conservative, because if they go lower, then the most that we end up paying for Rio is 62.22. If we did 10 of these or 14 of these or 15 of these, it would be a different spread. If we did 10, then this would be 10,000 minus 5 is 45. This would be $4,500. It's not a big deal. But I was just doing it as an example to show how you can do this without having extra costs. But if we sold 10 of these for $10,000 and these for $5,000, and that's us in for $4,500 minus $3,500. So we'd be in for net $1,000. And if we're doing 5 though, that would add $2 per share, and we'd be at 64.22. But I want it to be at 62.22. I feel very, very safe about that number. So instead we took the hit here, but we could have made this a $10,000 spread instead of a $7,000 spread for an extra $1,000. So if you want to be more bullish and spend $1,000 cash, because we spent 0 here, or we actually had a credit of 425, then you could have done it that way. And it's all trade-offs. But by the way, I'm thinking on that one, we didn't take this trade, but I would totally double down on this trade and roll the 772.22s are going to get rolled out to the 2024 whatevers, and we'll double down then. That's when we're going to make a more aggressive move. But first, let's take a look at Rio, see how they do, see what the quarter looks like, and then we'll decide. But as it seems to me right now, terribly undervalued. And that brings us back to yesterday. Now, we did a money talk portfolio review back on the 18th. And we're not going to go over it here because we just updated it. But anyway, I already made these moves. See where I said we're going to kill this, and we're going to keep that, and we're going to kill that. Oh, we didn't though. Oh, I forgot. We didn't kill SKT. Did something change? SunPower, Viacom. Anyway, did we not kill it? Can't wait to find out. I got to look. I forgot. No, we're going to catch this out. We did. See, I'm consistent. Okay. So the bottom line is IBM was, well, I write it down here, so let's just read what it says. So IBM, $24,000 spread, net $1,650. But the thing is, we started with a big credit on this one. So we're up 14, 20, 24. We're up $24,000. We could be up another 7. but we're currently up $24,000. That money is at risk. And this takes, so between now and January, if the market crashes, because we're only right at 139, and so if the market crashes and this trade gets blown, we could actually lose $24,000 here. So we're risking 24 to make 7 over the next few months. And I'm not positive we're going to make the 7. If I'm not positive we're going to make the 7, why do that? Why do I have a risk of 24 against a gain of 7? That's silly. My risk reward sucks. Sometimes if a put's like miles in the money or something like that, and then we're going to get 10% more and there's no risk, that's different. You can't say this is no risk when IBM is not even at 140, which is our goal. They're not even at 140. We don't, and you know, IBM's not at 140. We don't like the market. Okay, we expect it to be over 140, but it came down from 150 and really bummed us out recently. So it came down from 150. It's at 140. Can it go back up? Of course it can. Can it do this? Of course it can. This isn't 2019. This is this year. They got earnings coming up. We don't know if it's going to go up 10 or down 10, but if it goes down 10, we're going to lose 12,000 bucks. That would be stupid. So we don't take the risk. We take the risk off the table, and especially in a portfolio we can't touch. That's another very, very big thing about it. The money to our portfolio, we can't make adjustment based on earnings. We have to wait now until Thanksgiving-ish for me before I can adjust this thing. So you have to think all about that. Can I make a move? Not wait, will I make a move? Can I even make a move at that time? You know, sometimes when you're going on vacation, if you're taking a month off and going to Europe and you're not going to be really in touch with the market, for safety's sake, sometimes you want to lighten up on your portfolio just to, you know, not to be all overexposed when you can't pay attention to the markets. You know, if you're going to be on a cruise ship or whatever, it just depends on how connected you want to be and how connected you will be. You know, I go on a cruise ship. I wake up first thing in the morning. I go to the coffee shop or something, or I pay for now. I get Wi-Fi in the room. I used to have to go to the coffee shop. But you know, I wake up in the morning and I look at the markets for a while. If it's a good day, I leave. If not, I mean, you know, I'll do a shore thing or something like that. But if it's a tough market day, I'll stay and watch the markets. But then my family gets pissed off at me. I'm like, you guys have fun. I gotta watch this. So, you know, you have to decide whether you're going to be able to pay attention, whether you've got time for things, whether you want to be dragged down by watching all this stuff. You got to. So in this case, I always know I can't touch this portfolio in between times. But anytime you can't touch a portfolio, you've got to take that into account in your positions. Anyway, so we have Barrick Gold, GOLD, and here we're getting more aggressive. We're taking advantage of this dip. Fantastic for a new trade if you take this into account. We're rolling the 20 calls, which are 287, to the 15 calls at 278. That's all we're doing. We're just rolling. We're doing the same exact spread, except we're going to take 15 calls instead of the 20 calls. When the 2024s come out, we're going to roll these to 2024. Because we have a 15-27 spread, we're probably going to sell some short calls now because we have a very wide spread and we can afford to sell some in between calls to make some money. But as it is, we're in this trade for we were in for 29.50 here. That's 29.50 net. Now we're in for net 9,900, but we widened the spread to 30,000 bucks. It was 7 times 25, whatever that is. It was 17.5. So we almost doubled the size of the spread by spending $6,000 more dollars. We have now, but not only that though, but now we have the 15 calls, so we're $5 in the money. We weren't $5 in the money before we'd spent this money. So now we're $5 in the money, which is $12,500 in the money, compared to not being in the money at all before. So was it worth $6,000 to be $12,000 in the money? Yeah, of course it was. And you've always got, you have to be in a position. Look at this cash. I mean, you have to be in a position to make adjustments. And if you're going to stick with a position, you should make it a good position. You don't stick with a position hoping it comes back. That's a terrible way to play. You can't be down in a position and say, okay, I'm going to cross my fingers really hard. No, get yourself a better position if you want to stick with it. Why are you sticking with it if you're not willing to put in the money to make it work? It's like, goes back to being a house, right? If you really believe your house has value, when the wall crumbles, like let's say one side of your house crumbles down, like something went wrong, and the bricks fall down, and there's a big giant gap in your house. What do? You fix it. You don't cross your fingers and hope that the bricks come back. They're not coming back. But if you think your house has value and it's worth fixing, you fix it. And that's the same thing for stocks, okay? If your stocks have value and they need to be repaired, you need to spend the money to repair them. They are assets. They're not random they're not random numbers on a piece of paper. They're assets of value. And your position is an asset of value. Your stock certificates are worth something. But if you're doing options, they're worth something, and that something has to be within the realm of reality on your options. So you have to pay to make your options realistic, and if you're not going to do that, you're basically just praying. And that's not a good strategy for making money in the long term. No disrespect to God, but he just doesn't tend to hand out the cash. IBM, where are we? Okay. So IBM, we're cashing this one in. It's a 20. Oh, we just said that. Sorry about that. Pfizer. So booster shots are coming. Pfizer's working on an oral COVID vaccine. That'll be nice. We can just pop pills. Well, that'd be great. They can have, out of this crisis, Pfizer's going to end up with something that they can sell you all the time. Brand new multi-billion-dollar forever drug that we'll be taking. So 16 months, we're going to be in that 47.65. There's no imaginable danger. That's the point. So the Pfizer position, that's what I was just talking about before. The Pfizer position is a 30-37 spread with $35 puts. Okay. Currently, we're net 47.65. If it stays above 37, see it down here. If it stays above 37, we make $2,500 more. Okay, that's worth it because there's no reason we think it's possibly going to do that. That seems ridiculous to go back to 37. Highly, highly unlikely. There's a very tiny, and if it did, we'd be probably buying a lot more Pfizer. Any position also, that also becomes something you take into. If Pfizer went to 5, it's not a loss for this position, but 30 puts. If we get to 30, what was that? Well, that was weird. What happened? Never heard that before. That was weird. That was like feedback or something. Hopefully everything's working okay. Can you guys, okay, somebody tell me I can hear you so I can make sure this is still working, because that was something that never happened before on this thing. I don't know what the heck that was. I just suddenly heard a weird sound. Everything looks normal. It seems to be responding. Is anybody still out there? Hello? Audio is strange. All good now, though? Are we okay? I guess if I don't talk, nobody can tell, but we're good. Okay, thank you guys. All right, I appreciate it. I don't know what that was. Something weird happened. I like heard a feedback of my voice or something. Anyway, all of a sudden, it was just weird. Where were we? Pfizer, yes. So it's only a tiny little spread. We're only committing to 500 shares, blah, blah, blah. So of course, if it goes down below 30, if it goes to 30 for whatever reason, I can't even imagine a situation in which Pfizer sells off down to 35 or 30, and I don't want to like double down the position into 2024. Not unless the vaccine starts killing people somehow, which would suck. Oh, by the way, apparently Moderna, which fortunately I got Moderna, but apparently Moderna is much better than Pfizer. Apparently Moderna is by far the best vaccine. So got that going for us, and I think that's why Pfizer sold off a bit recently, but it doesn't matter. Pfizer is still effective. It's just not as effective. And Pfizer is, as I said, they're working on the oral vaccine, and each variant they're going to have, it's just a whole new thing every time a new variant comes out. So it doesn't mean Pfizer is always going to be behind Moderna. But anyway, so there you go. So this is a keeper because we don't see any reason it's going to go below 36. If it goes below 36, I could care less. 35. SKT, on the other hand, it's 97.30 out of 10,000. So that's just it. We're going to get called away. Okay, we could get called. We would get called away, but it's silly. So we're just going to cash it out. It's not worth it. Not that we think anything bad is going to happen to it. We're getting cashed out at $10. Our target was 10. We're at 16, so it's pointless. But again, our lack of ability to adjust this thing otherwise says, why not cash it out now? What is that? Go away. SunPower. Why did we not buy more SunPower? I'm stumped. They pulled way back and barely better than our entry on a $15,000 spread, which is currently, okay, this has a huge upside still, 36.12, and it's a $15,000 spread, $11,000 upside. When the 2024 calls comes out, we're going to roll. Oh, I see it. I decided to wait for 2024. I'm like, why didn't we add to this now? I don't know if I agree with my decision. I already have doubts about this because I'm thinking like, I don't know why, because this is such a stupidly low price for SunPower. We have this in like all of our portfolios now because it's so cheap. This is just ridiculous. And again, SunPower has value. You got a whole big trend of solar installations. You have a whole big trend of a government that's only been in power for a year. Biden's only been here for 1 year. Going to be here for 3 more years. And they absolutely want to push solar and wind and all, any renewables, but they're going to absolutely be pushing solar for 3 years. So we have 3 really good years ahead of us. SunPower is a US-based company. They don't import a lot from China. We just checked that because we were saying, what the hell is going on with this company? They don't even buy a lot of chips from China. They're a perfect solar company. Great product, great positioning, and the government's going to push this stuff. I don't even understand how it's this price. So like, yes, we should have gotten more aggressive there. Oh, I guess part of it was I just don't want to overwhelm the TD people, the money tort people, because they're, not necessarily sophisticated. But honestly, I would absolutely go to the other portfolios. I would absolutely push this position. We got Viacom, another one that's ridiculously cheap. They just made $1 billion last quarter. They made $1 billion a quarter before that. Basically, they're going to make $4 billion, and the whole company is $26 billion. I don't get it. I really don't. I don't understand why people just hate stocks for some reason. So don't tell me there's nothing to buy. There's plenty of stuff to buy. Just freaking fill your portfolio with SunPower, Viacom, Barrick Gold. This portfolio is amazingly good, actually. But given that, what did we decide to do with it? Well, now we got rid of IBM and we got rid of SKT. I said we got rid of IBM, so now we need some more tech. So let's go to Hewlett-Packard. And we already talked about that. That was a top trade earlier this week. And what's up with Hewlett-Packard? Well, they're only at $37 billion, $35 billion, 36 basically. They make $4 billion a year. And again, here's how I look at it. I go back and I say, well, what are these guys doing? Great boring company, 35.7. 4.5, 2.5, 2.5, 5 something, 3 something, 3. Last year, again, I love any company that makes good money last year is a friend of mine. So they basically 3, 4.5, 4. They're good for $4 billion a year, pretty much on the average. These years average $4 billion too. So they're good for about $4 billion a year. That's great. They're growing. See these revenues? Nice bumping up in revenues. And I have always maintained, everybody says, what's your favorite 3D printer play? I say Hewlett-Packard. And they say Hewlett-Packard doesn't even do 3D printers. I'm like, yeah, because it's not ready to be mass produced yet. When they're ready to be mass produced, when there's a reason that you should have a 3D printer in your home or office, then Hewlett-Packard will make them. But realistically, what possible use do you have for a 3D printer? Still to this day, the technology of a 3D printer hasn't gone to the point where it does much. So Hewlett-Packard, when they want to, they're a huge company. You know, you look at DDD, right? They still exist. They do. DDD. 3D Systems is a $4 billion company with $500 million in sales at a loss. They say they're going to make money this year. This is the year they're going to make money, though. That's what they say. That's pretty funny. If they make it, God bless them. They're going to be that. I mean, if they make it, they're going to be a good deal. I'm not an anti-3D printer at all. These guys are probably coming into their own. These probably would have been a good pickup last year when they were $6. Now they're $30. But the point being, it's a pissant little company. Hewlett-Packard, you can just buy them right now for $6 billion and be done with it. They have no reason to feel like they're missing out on this thing. There's nothing there that they can't build themselves, and they've got the cash and they've got the wherewithal to be able to move into this space whenever they want to. So I think that when you do get 3D printers, it's going to be HP 3D printers. It's HP, IBM, people like that. I don't know what are you going to do with a 3D printer? Even if you said, oh, you could print anything with a 3D printer, what would you print? I think, you know, for a mechanic, an auto mechanic, printing car parts, super useful for airplane people, airplane parts. People who need things like parts that can be made out of one piece of metal and printed, great. In theory, you're going to be able to print food. But that's a whole different thing, that they'll be able to assemble food out of 3D printing. So that's far in the future. Honestly, you really got to stretch to think of, like, why do I even want a 3D printer? What are you doing with it? I guess it's fun for kids to play with, but that's the problem. I mean, it's a toy. It's not the most efficient way to make something. It's efficient for a mechanic because he needs 1,000 different parts and he has to get them by mail or whatever. If he can print some of those parts, that obviously is going to save his operation time and effort and so on and so forth. But most things, like I got a nail clipper in front of me, right? And it's basically, I guess you could make one on a 3D printer. You could assemble the pieces and make it and whatever. But why would I do that when I can go down to Walgreens and give them $5? Why am I going to sit there and have a 12-hour job, like creating this a nail clipper, and I'm sure somehow assembling it in the spring thing wouldn't be able to be printed. You know, why? It doesn't make any sense. It's like I wouldn't have a printer for that purpose, to avoid going to the store. So anyway, it's HP. So HP printer company. Bottom line is that they're a printer company, and the work at home thing. Oh, that's where the boost came from. It's the work at home stuff that boosted them. The reason their revenue skied is because all these people needed, all these people who are working at home, which is about 2/3 of the workforce right now still. 2/3 of the people who used to be office workers anyway, not of the total workforce. so that all those people who used to have a printer that they would share with the office, they all have to have printers at home now. And that's caused a huge demand for printers to the point where they're constrained in supply. And that's what depressed Hewlett-Packard stock recently. Was the CEO said in the earnings report. He goes, we are supply constrained with product. We have more orders than we can actually fulfill. And it had a spectacular earnings report, and that knocked him down. I thought that was the stupidest thing. It was right here this day. And I said that day, I said, that's when we made a play. Because I was like, oh my God, that is really dumb. It's like, you know, we can't possibly meet the demand, therefore people sold the stock. They're in great shape. They're super undervalued, really crazy numbers here. And here we were pretty aggressive because which portfolio was this for? I don't know. Oh, I'm sorry, this is Money Talk. This is the Money Talk portfolio. So in the Money Talk portfolio, we commit to buying, we're selling 20 of the 27 puts. So that's going to be $54,000 should we be assigned, which is a lot of money in the portfolio, which is only 200,000 bucks. See, we're at 200,000 in the portfolio. But again, this is where it goes back to what we were talking about before, realistic risk. I don't have a realistic risk that Hewlett-Packard will go to 18. We're committing to buy it at 27. So at 18 would be stupidly cheap, and that would be a loss of we spent net zero on the spread, so we'd be down 9 times 20. We'd be down $18,000. So the risk of the trade is $18,000 that we expect to lose if Hewlett-Packard, for some reason, gets horrifically torn to shreds and drops almost 50% in value. Then we might lose $18,000. And that, again, assumes we don't do anything about it, we don't change anything, so on and so forth. So in a worst case scenario, I don't think this thing's going to take up more than 10% of my portfolio or hit me for more than 10% of my portfolio. In a best case, in a not even a best case, in a fairly normal scenario where they get back to 35 in 2 years, then I think we're going to make $20,000, 10% of the portfolio. So the risk equals the reward, and I really don't believe that the risk is there. But the worst possible risk I can imagine is this. The problem is other people say, oh my God, you can't risk $54,000 because that's what we're doing, but we're not risking it. We're risking owning $54,000 worth of Hewlett-Packard. That's not risking $54,000. And again, it goes back to if you have a house and it's a $500,000 house and you pay $500,000 for that house, are you risking $500,000? No, it's not. It's not really conceivable. Could that? Yeah, if I have no insurance and the house burns down and blah blah blah, and there's nothing left or whatever, maybe you still have the land. But you know, how do you get to zero? And if you can't get to zero, then it's not a $500,000 risk. What can you get to? Can you get to 250? I guess you can get to 250. In 2008, a lot of people went from 500,000 to 250. And if you had to sell and you're forced to sell, maybe you'll end up selling at 250. But your risk is never $500,000. You know, unless it's some catastrophe where the world's ending, basically. In which case, well, who cares? You know, in which case, well, what can you do? But in a normal world, in anything that we could really imagine happening, it's got a value. And that's how I look at Hewlett-Packard, the same way you look at your house. You know, you have to value a stock the way you value anything that you actually know the price of. You know, and as you know, I went through my life. I've been a business consultant, a valuation expert, and this is what you do. Is there a value to this company? Of course, there's a value to this company. It's based on the sustainability of their long-term revenues and their sustainability of their profit margins. And you look at that. You look at the supply chain. They don't make complicated equipment. Laser printer. We had laser printers 30 years ago, right? We had laser printers. I mean, laser printers been around for a long, long time. I remember getting, oh my God, I remember getting the first laser jet. It was $3,500, and it was amazing. I was so blown away. I almost cried. I was just like, I could not believe how great that technology was at the time. It's the same technology now, though. There's not, so in other words, the stuff that they have, chip shortage or not, they haven't really done that much with a laser printer. It freaking prints out paper, uses toner, so on and so forth. It's not that complicated. That's why they're so cheap now. They're crazy cheap. And Hewlett-Packard switched their business model because you can't make the money on the electronics. There's nothing in it. There's nothing to justify a big profit margin in the electronics. They make their money on toner. They make their money on ink and toner. Ink for inkjets, toner for laser jets. And they've got a consulting arm, and they've got an enterprise arm that does all the enterprise computing and things like that. So they've got services. Great. It's a great little company, and they're really very embedded in the industry. And there's not much competition for them, actually. You know, it used to be like so many different companies doing this stuff. Hewlett-Packard's the survivor of all this stuff. And they used to be, you know, they used to be dominant anyway, and they're more so dominant now than they were. The next one is we like the trend of sports betting, obviously, because that's going to be a whole thing. You know how Americans are. So I mean, if you can bet on sports, they're going to bet on sports for sure. So online sports betting, Boyd is one of the players. And we talked about how there's various players, but you know, you go to DraftKings, they're 100 times earnings and so on and so forth. You know, Boyd is they make $500 million a year now without expanding and without the sports betting. They make $500 million now, and they're a $7 billion company, so they're at 14 times earnings. And we think that they've got a very good chance of expanding and going higher. So given that, we took a pretty aggressive play. But again, we're selling 10 of the $50 puts because there's a baseline value to them that we think is definitely higher. That's about 10%, you know, it's 15% below where we are now. So basically a $6 billion valuation. We think a $6 billion valuation is getting close to a PE of 10. I think that's very easily justified. Therefore, we don't anticipate it going much below 50. We don't see that it's likely to go below 50. If it holds 50, we're in good shape because we're selling the $50 puts and we're spending the $6,500 on the spread. We have a plan to sell short calls because we think it's going to be a rocky ride getting there. So we sell some short calls against it. But here we're spending $6,500 on a $40,000 spread. It's $14,000 in the money to start the spread. And also, though, we're going to sell these 2,000 4 times. We're probably going to sell 8,000 total dollars against it, but 6,000 more than we sold so far, which would drop our net to $500. So it's less risky than it looks. Our worst case is going to be owning some BYD for $50. And if we do that, then we'll sell more puts and we'll sell some covered calls and so on and so forth. But most likely, we'll be very happy to roll out to 2024, 2025, whatever, and keep playing along as this industry matures. But these are great spreads. I mean, here we've got a $33,000 upside on this spread, and on this spread we had a $20,000 upside. So that's $53,500 of upside on 2 spreads. And that's why there's nothing wrong with going back to cash, like we did a couple of weeks ago in our portfolios. We went back to mostly cash. This one is lagging because we only just now got to adjust it because the show finally came around. Couldn't do the adjustment until now. But we're going back to cash. It gives us the flexibility to jump onto these opportunities, and they'll come around all the time. You know, and that goes back to the top trade stuff. You know, we did these top trade reviews. I think I've got them in here now. That's a top trade alert, LPL, trucks. Wow. I thought I put the reviews in here. I guess I didn't. Or in the portfolio reviews. That's kind of weird. Oh, yeah. Here they are. So they're in the portfolio reviews. So the top trade reviews for Q2 and Q3 and Q1 must be somewhere else. Oh, Q1. So we reviewed, and I got to finish up, you know, I got to finish up the 2020s. But the top trade reviews mostly went in portfolios. But just to give you an idea of how often we do this, oops. So in the first 3 quarters, and so basically we're 37 for 38. So basically there's 10 of these per quarter. So in 12 weeks, there's going to be 10 top trades. That's how they've been running. Is that right? Yeah. And we were right. Really? 36. Wow, 36. 36 out of 38 of the trades were profitable. And what did we make? And they were profitable for $591,000. So that was only the first 3 quarters of the year in 2020. Obviously, we had the big dip in March. It gave us some really nice returns. But the point is, that's the frequency at which we do it. Basically, at least once a week, or not at least, but pretty much once a week, we find something we want to trade that's so good that we call it a top trade. Our consistency on the top trades is 95% winners. Although historically 70% winners, this is a crazy up market, so nothing is a loser basically. Historically though, we're 70% with top trades anyway, and 70% is fantastic. If you can be right 70% of the time trading, you are going to make a lot of money. And that's what we're doing again. But how do you put the top trades into your portfolio? You have to have cash on the side to do it with. So when there's an opportunity, we get onto it and we trade it. And that's what this whole thing is all about. And look what the top trades were recently. Well, look what they were back here, which was when? September of 2020. Pfizer. It's so funny. It's the same things that are in the we just talked about. There was Pfizer, there was LNG, there was Macy's, there was Viacom, there's WBA, Yodi's favorite, Intel was our trade of the year, AT&T, another one that's stupidly cheap right now that can be bought. So those were the third quarter trades from last year, and they're no different than the stuff we like now. We still love Intel. We still love AT&T. Intel's suffering from being chip constrained. AT&T, I have no idea why they're trading down so much. It's crazy. But that happens to AT&T all the time. You go back historically and you look at AT&T. This is their trading range. So let's go. How far back are we going here? So since the crash in 2000, basically AT&T bottoms out around $25 and it tops out around $40. That's their range. So when it's near 25, a smart person starts buying it, and when it's up around 40, when it goes over 40, a smart person starts selling it. And it's always going to do that because they dump all their money, they pay off so much in dividends, and then they're always rebuilding. The way the telecommunication world works now, you have 3G, 4G, 5G, 6G, 7G, 8G. They've always got to reinvest in new stuff. And we had fiber for a while, and now we don't need the fiber because we have 5G, and 5G is as good as fiber, basically. Blah blah blah. It's like it's such a crazy business. What was the thing before that? There was something with the copper wire that was faster. I forgot what that was called. It was terrible. We're using the same copper. As soon as they say you're using the same copper wiring, I'm like, how is that going to be better? I mean, that makes no sense. You're sending me the same signal on the same phone line, and you're trying to tell me it's going to be much faster. It's not. That didn't last long. It's all about how close they get the fiber to your house, so the optical cables. But anyway, constantly, it's a cyclical business. That's what it is. And you play the cycles. When you're investing in a cyclical business, you play the cycles. It's not complicated. And they pay out a huge dividend. It's like 7% right now. And it's, I mean, it's AT&T. It's also right now it's HBO, but they're spinning out HBO. So we'll see what happens with the new looking company. Time Warner is getting spun out. Even after they took it over, they're spinning it out. It's really crazy. But that's just how these companies work, and they're just cash machines. So it's a great thing to invest in, and if they're going to be giving it away, then take it. Don't question it. Say thank you. I appreciate that. So anyway, bottom line, plenty of things to buy. Oh, we got logged out of Stockopedia. There's plenty of things to buy. And we're in no hurry to buy them. We're certainly not in a hurry before the September earnings start coming out in about 2 weeks. We'll start seeing earnings reports. Do they do upcoming earnings in advance? I don't know if they do. It's weird. There's like constant earnings. This earnings season kicked off late, and there's still lots of companies reporting. And after the holidays, this weekend coming up, probably about a week or two after that, we start with the earnings again. Now we're going to start seeing the early reports for the third quarter earnings. July, August. Oh no, I'm sorry, we're not. I apologize. It's October. It's because we got to cover July, August, September. I'm sorry, I'm thinking this is October and it's not September. So in October, we'll start seeing the next round of earnings. Until then, I mean, if we find something really cheap, and there's plenty of stuff that is really cheap, we can add it back into the portfolios, but we want to see how they perform. This month, we'll take a look at how they're performing in the lighter versions of the portfolios. And then we'll decide what we're going to add and what we're going to, well, we won't, not much to subtract, but we'll decide what we're going to add to them to boost up the income. All right, so I'm going to wrap this up because I got to get on a call. Let's see what we got here. See if anything exciting is happening. Oh, not that, charts. Nope, everything's just chugging along. The Dow's down a little bit. The S&P is a little bit up. The NASDAQ is nicely up a half a point. Really jamming it along, huh? And the Russell's up a little bit. So everything seems perfectly normal and perfectly good. Oil had a good day. They're back over 68.50. Gasoline, yeah, they're a little bit disappointed from that 1030 report. And going back up, natural gas over our 450 target. We're done with natural gas. That's it officially. I predicted 450 many years ago. It is now at 450. We are done, out, and we're all happy. Our LNG, everything paid off. You know, and again, it's just a macro trend. You know, you look at what's going to happen. We saw the LNG that was going to be exporting gas out of the country, and my premise was in Asia, natural gas was $8 to $10. In Europe, natural gas was $6 to $8, and in the U.S., the natural gas was $2. And so what was going to happen? All the $2 gas from the U.S. would be sold once you can put it in these ships and sell them, the LNG. It's going to go to Asia and it's going to go to Europe, and the prices will merge at a certain point. And based on the volume and the capacity and the construction of the LNG terminals, we figured that 450 would be about the price that global prices would sort of settle in on. Oh, but then, I'm sorry, then what's going to happen is because people are still building LNG terminals, they're very long-term projects, and people are moving to more and more natural gas solutions, what's going to happen is we're now going to end up having a glut of natural gas as everybody is exporting to everybody else, and there's going to be actually more natural gas produced than people need, and the prices are going to go down. So, you know, this is basically going to be the top of the natural gas. It might spike up a bit or whatever, but over the next couple of years, you're going to see prices actually drift lower because there's too many natural gas projects being put together. Too much natural gas is going to be put on the market, and it's going to flood the market with natural gas. And all of a sudden, everybody's going to say, okay, we got enough of this. That's fine. So it's still the same prediction I had from years ago. I said, this is what's going to happen. You're going to have a cycle. It's going to be this. They're going to overbuild it, and it's going to go down. We are now at the point finally of the 450 equilibrium that we hit on a worldwide basis. And then comes the oversupply as the next part of this. All right, well, thank you everybody for coming. Anybody got a question or anything like that? Nobody had a particular question. That is fantastic. And thanks everybody. We'll do this again next week. Appreciate it. Take care.